Hello and welcome to another episode of the Visual VC podcast. This podcast is your go-to resource for practical advice and insights on building, growing, securing funding for your startup. I'm Daniel Zaturansky, your host. And today we have a special guest, Avery Schwartz. Avery is a partner at Greenfield Partners, an investment fund based in Israel and the US. Greenfield Partners specializes in backing early growth technology businesses. Avery holds board positions at notable startups and is known for his contribution and growth of the support of his portfolio companies. So get ready to be inspired. Avery Schwartz, an expert in the investment field, will share valuable insights on startup growth, funding, and the state of their current markets. Let's dive right into the conversation with Avery Schwartz. Hello, Avery. How are you?
Hi, Daniel. Thank you for that intro. We can only go downhill from there.
Yes.
But appreciate
it's so exciting to have you on the show. I mean, we're trying to kind of reach you for a while, and now it is finally we're there. And so I'm really impressed of your wide range of experience in the investment world. You came from investment banking, and then you grew out into the private equity. So let us give us some background about yourself, and just give us a taste of your journey into Greenfield Partnerships.
Sure. So yeah, a little bit of a different journey. I studied English literature in college, and through a few hops, eventually made my way into the world of VC. The most significant of which were in investment banking. I spent almost 7 years at Goldman Sachs, and following investment banking about 5.5 years ago, I joined Greenfield Partners while we were still under the umbrella of TPG, a US-based private equity.
Nice. And so what brought you into the investment world? You've been studying literature. What attracted you to that?
I guess a series of, a combination of fortuitous events and following things that really interested me. So meeting people that kind of brought me into different, closer and closer to the world of finance and VC. And also just being really attracted to that world and it being a good fit. These types of things, for example, investment banking. I think if you speak with people, if you end up staying there for almost 7 years, which many people might argue is too long, there must be some kind of passion that you enjoy because the hours are pretty grueling. And I think that's one of the things I discovered, that I actually really like the work. And that eventually led to at least having the tooling that allowed me to kind of break into VC as a growth investor, and have since kind of keep improving and learning every day with Greenfield Partners now.
Any notable deal that you're really proud of?
Well, one deal recently in the news is a company called Vast Data, creating kind of the next generation AI data platform for the AI age. That's one that we're really excited about, the potential for that business, and it's the type of deal that we really like because it's really on the infrastructure level that enables a lot of applications on top of that. And it can be boring to some people, but we're really excited about those types of companies.
And what was your involvement in that deal?
I think it's a team effort, but I was one of the individuals to be fortunate enough to lead the deal and stay involved with the company since the original investment in 2019. So really getting to see how the company's developed over the last 4 or 5 years has been amazingly instructive, and it's really great to see excellence from up close. And I think that helps you as a VC when you're kind of pattern matching that excellence, both in terms of identifying companies like that, but also in terms of helping the companies you work with knowing what excellent looks like in different phases of the business, I think is can be helpful.
Can you explain the different phases of early growth investment and how they relate to the go-to-market process of a company?
So maybe I'll generalize it a bit more because I think it's kind of, these are types of things that we'll look at for many types of businesses that might be instructive. So to take a step back, I think there's different phases of investment that investors typically enter at. So you have the early investors who might invest at the seed stage or the Series A stage. And you might have late stage investors that invest at Series D or E or pre-IPO. Our typical investment stage will be at the Series B or C stage, and we call that early growth. So what typically happens in the life cycle of a company at that point is the company's managed to start going to market and actually build a go-to-market machine. So they're starting to sell, and it's no longer just the founder selling. The founder's hired some executives on the sales and marketing side and account executives. And when I say go-to-market machine, think about it as just to name a few parts of that, right? You need to be able to generate leads, not just through connections, but through a more repeatable way of generating leads. And there's different ways of doing that, and shift them through the funnel and have titles. This may not mean something to people, but BDRs and SDRs, and convert those leads and qualify them and enable the salespeople to sell what you're providing in the most efficient way to kind of get them, quote unquote, down the funnel towards eventually converting them into a paying customer. And at the very early stages of having built that machine and starting to see the health of that machine, we call that finding. People talk about finding product market fit, which is I think in the early phase of the company's very agile and is going to the customer and hearing feedback and coming back and tweaking the product. And Daniel, you probably know this a lot better than I do and have experienced it more firsthand. But then there's a phase that we call product market sales fit, where the sales motion enabling the scaling of that product market fit that you found matches the type of business, and you've kind of defined your ICP, ideal customer profile. And so what we want to see is we want to evaluate what that looks like, and whether it pattern matches to things that we've seen where it's healthy. And sometimes there might be elements that maybe other investors don't appreciate, but that may not look so great on the surface. But actually, there's a diamond in the rough there. There are key elements that are actually really healthy, and the other things are more call it execution elements that maybe we can help with. And I can talk about, I think one of the key recent moves we made as a fund is bringing on an operating partner. And I can talk about that in a moment, but I've already gotten very long-winded, but that's kind of the stage at which we enter. And I'll pause there just to, I'll let you, Daniel, take me in any direction you
I first love this direction because this is really super interesting, and specifically for me, because my company going through that process as well. And specifically, we're talking about a product market sales fit. Which is can you describe this stage and what are the KPIs or success metrics?
Yeah, so to talk about KPIs, I would say let's maybe extrapolate backwards from the end goal, right? And it's kind of unfortunate to talk in these terms, but ultimately when you're talking about business that gets to the public markets and is traded, it kind of gets abstracted into the financial value of that business, right? And the stories and all of that, ultimately, if it can't be converted into an attractive financial profile, and yes, taking into account certain elements of growth, et cetera, then that's really what's dictating the financial value. And a lot of what ends up dictating the financial value is the financial profile of the business. And what do I mean by that? You have your revenues and your gross profit, and then your operating profit, eventually your net income. And probably the key engine of how attractive the financial profile is going to be is you have your gross margin, which in software generally is pretty attractive. By that I mean the incremental cost of providing an additional copy is cost virtually zero, and you have maybe cloud costs associated with and customer service costs, but you typically high gross margin business. And what it comes down to a lot for software business is what people call sales efficiency. And think about efficiency in anything, right? If you think about someone who runs in a very efficient way, it ultimately comes down to what's the ratio between input and output, right? So when someone runs efficiently, you see it's beautiful, tremendous output, great speed, and very little input. They almost seem like they're not exerting any effort and they're running so quickly. That's really efficient. So I think a business, you can think about it in the same way, where the input is all what you're putting into on the sales and marketing perspective. And the output is the new business that you're generating in terms of new revenue, or typically in software, it's called ARR, annual recurring revenue. And so the ratio between those two numbers is really important. And I think that what we've seen is that at scale, when companies become really big, changing that ratio becomes very difficult, because when you double click and you get out of these abstracted terms, it talks about, what happens is you have an account executive who's used to having, a sales engineer and a BDR and an SDR. So there's a lot of effort that's going into creating a sale. And when you have to pare that down at scale, it's very difficult. And so what we try to focus on is, how do we identify places where there's a very efficient motion in terms of the ratio between, let's say, the sales and marketing spend and the new ARR being produced, and also where can we maybe help? Where are there easy wins in order to change the ratio when the company's a lot younger and more nimble? And sometimes you might hear the term magic number. So magic number is that KPI which says, okay, how much new ARR have you generated this quarter? Typically you offset, you say, oh, what was the previous quarter's S&M, because that's when most of the effort went in, and the ratio between that number is the magic number, and you want a magic number above 0.7 or so. That's a typical, and there's a reason why that is, but probably too much detail for this podcast.
Yeah. What is the secret sauce for those that managing to get to the right KPI and ROI?
Yeah, that's a very good question. And it kind of touches on something that I mentioned earlier, and I'll expand on now, which is the hiring of our operating partners. So we were very, very fortunate to welcome Nir Goldstein, who was previously VP Sales at Monday.com, one of Israel's premier SaaS companies, and maybe one of the premier SaaS companies globally, really known for their sales efficiency, which they've done an amazing job on. And Nir was a critical element of helping them create that. And, one of the things we noticed as a fund was that you have, former bankers like myself that, we could crunch numbers all day, and we have a head of data that can actually help you bring your data in from your Salesforce and HubSpot into a data warehouse like a Snowflake and surface it through a BI tool like a Tableau. But eventually it's, okay, well, how do you, and you can say, oh, well, you're not efficient in this and this and this metric, and we benchmarks from across the ecosystem. But then the question is, well, how do you create that sales efficiency? And I think that what Nir brings is the ability to really diagnose on a tactical level all the different elements of that go-to-market machine that I identified earlier. You generating leads and taking them through the funnel. He's someone that can listen to calls on Gong, which records calls of salespeople, see what people are doing. Are people being enabled properly? What types of leads are their salespeople bringing in? Are they better bringing bigger leads or smaller leads? Are they bringing are they good at closing your ideal customer profile or not? What does the handoff look like between marketing and sales, and then customer success? All these tactical things where I think what differentiates companies a lot, and I should say a lot of it is product and thesis around the product, but assuming that those things are good, it's what does excellent look like in a go-to-market machine? And I think that's something that is lacking in the ecosystem. And I think is where we as a fund are trying to provide value by showing what A plus looks like, where otherwise sometimes people may not be able to differentiate between what a B plus go-to-market motion looks like versus what an A plus one looks like.
And where do you see most companies fail?
That's a good question. I think, probably the inverse of that. And, look, I think the default state, unfortunately, for startups is failure, right? If you cannot, there's a tremendous power of gravity pulling against startups at all stages towards failure, or, it sounds harsh, but, maybe there's a better way of phrasing that. But it's hard. It's hard work. My wife is a founder, and so I definitely get to experience that from up close. And being with these companies, that if you don't rise above the noise in your market and ensure that everything is done, in an A plus way, extremely tightly, extremely well done, integrated, and everyone's rowing in the right direction, chaos can reign and things can start to fall apart, and you start to find yourself playing defense rather than offense, right? And once you start, plugging holes because this wasn't good enough and that wasn't good enough, it's very hard to recover that momentum and start playing offense. And so you really want to be able to see around the corner, identify things that might break 6 months from now, rather than having them break and then start to repair, because there's a lot of momentum in this business, and you can find yourself losing that kind of growth, offense-minded momentum, and find yourself on the defense. I think that's what some of the better companies are, seeing around the corner a little bit better and identifying weaknesses before they have a chance to manifest themselves in the business.
Yeah, it's eventually down to hard work, patience, and really understand your market, provide the best product. But then, you need to go found your audience. That's the most important thing.
I definitely did not spend enough time on the answer on product, so that gets a special call out. I think, where we try to add value is on the go-to-market, but obviously product continues to be a very important part of that equation as well.
What is the investment criteria that Greenfield going to go after? What companies would you say yes to and why?
Yeah, so we try to be pretty focused. And one of the things that might be instructive to other people is to think about a fund that, we're raising money from institutions around the world. And so, just like, companies are raising from us, we have a product that we're selling to the investor ecosystem. And so we have to really tightly define what that product is. And I think it's a very healthy part of the process for funds. And so, what we sell to our investors is saying, look, we're going to be very focused, and we're going to try to be world-class investors in our focus area. And that focus area is, like I said, that kind of Series B, C stage, really focusing on the challenges that entrepreneurs face at those stages of the business and building the infrastructure of our fund to support those founders. And probably 70% of what we do is within specific verticals like cybersecurity, data infrastructure, IT infrastructure, and we'll do, with the remaining 30%, we'll do some fintech, we've done some consumer, and we'll do other things, but we want to make sure that we have the ability to help the founders that we invest in to the extent possible. And that's kind of how we define the focus area. And so usually from a metrics perspective, that'll be starting from about $3 to $5 million in revenue or ARR up to about 20 million. And from above that stage, typically that's what we call ourselves early growth. That's more kind of traditional growth. It's a bigger check size. It's a later stage, and that would usually be a different class of investor to come in what would typically be a Series D or E investment.
In your stage, what is the check size?
So our check size range is typically $15 to $30 million. We can flex down, flex up on a special case by case basis, but that's our sweet spot.
And do you do a secondary as well on your?
What we've found that works for us well is to do primary investments, lead rounds. So that would mean taking a board seat, and so that we're incentivized to bring the entire resources of the fund to bear for that business.
Okay, it's easier now to go out and build a company using AI machines, your marketing machine development. Do you think that those new companies that can replicate an existing companies, the existing large organization that may be a little bit less innovative, but still they're pretty good? Do you think they're can be competing by price and eventually outperforming?
I think that there's definitely been a productivity boost. A few things probably to say about this. I don't want to get too long-winded, but one thing I think with AI, I think one of the things we're seeing is that actually big companies are leveraging it pretty well, which is unlike something like cloud, which required a much bigger lift from big companies to take advantage of. Big companies are actually doing a pretty decent job of leveraging AI. So that's one. At the same time, I think there are big companies that maybe are providing a service that is relatively easily replicable software that have made a lot of money by being really big player, but don't really have any network effects. So there's no real reason for them to necessarily be 80% market share and charging a lot of money, and someone could come in and offer the same essentially for 10 cents on the dollar. Those companies are probably going to be disrupted. And one other thing, I think there's a bit of a narrative around are there companies going to raise a lot of are there going to be like super lean companies created? I think in the early stages potentially you can kind of have more be more productive, but I think that when you get to the go to market and there's just so much noise that you need to typically spend, unless your product is so much better, you need to spend to get the awareness out there. And so you either have to be so much better from a tech perspective, in which case you can't just have 4 people coding with productivity because it's highly replicable and you can't get the tech differentiation, or you actually have to spend the money on S&M. So either way, I think you are going to have to, people are going to have to spend a bit more money than I think what's maybe being hoped for. And that comes back to, I think, a lot of that, the go-to-market motion, getting a product in front of people, articulating the message. I think it's something, those are really important principles that are going to continue to be mostly true even through the cycle.
Yeah, I tend to agree with that, because to build a sales machine, it costs a lot of money. You need to invest in SDR, salespeople, marketing, and everything, CSM. So obviously people cost money, and you really can't replace them with it still today, with the AI machine. So let's see, maybe within 3 to 5 years, it's going to be a different story. We're going to replicate it. You're going to be machine replicating us and doing a podcast for us and doing a sales calls and so on and so forth.
Yeah, well, you have to speak to an early stage investor for that, or the founders. That's too far down the field and too creative, probably. How
do you see the investment environment changing in light of the high interest rates now in the markets and obviously the economy slowdown?
Yeah, good question. I think I try not to get overcomplicate things. Rates obviously have dictate a lot. When rates are high, the simplest way of looking at it is people have an alternative where they can make a decent return, and so the bar is higher on alternative investments, and VC falls into that bucket, and so that puts an impact on how much capital is being allocated to VC, and so it has an impact on maybe some VC funds aren't going to make it through the cycle. Other VC funds need to be smaller, and it puts a bit of pressure on the asset class from capital perspective, and that's what puts pressure on deployment. But that's kind of the macro in view. I think from micro out, great companies are created throughout every cycle, and we're fortunate enough to be in a position where we have a lot of fresh capital to deploy from our newest fund, and we're really excited about this vintage and the types of companies that are getting founded now. There's big shifts afoot, as you've alluded to, and we want to be active. And we think we don't have to invest in the full macro environment of every company out there. We need to find those 3 or 4 companies a year that we are super excited about, and then just get behind those companies as much as possible.
Exactly, just make you a super laser targeted correction product market. We discussed about the latest trend in tech, such as AI, blockchain, biotech, anything that you receive from your existing portfolio or from the one that haven't seen yet.
Obviously, AI is a big one. We're following it. I would say, from our, in terms of the types of AI companies we're interested in, and also I think there's some more interesting Israeli founders coming through who seem to be getting this right, is around kind of the infrastructure component. So there was this, there was a space that was called ML Ops, machine learning operations. That if so, you can find our website. We did a whole research on it, and that basically AI, the emergence of generative AI just kind of blew up that whole space. And there's a new way of a lot of new things coming through. But I think Israeli founders were strong there, and I think they'll be a key part of what that new version of ML ops, or however you want to call it, will look like. And that's an area which, again, I think it's kind of maybe boring and not sexy to some people, but we really like it as an enabling infrastructure technology. And at the application layer, it's still a little bit tougher to call with AI companies. And then at the very base, LLM model level, I think that's looks like there's going to be some big winners that we're probably not going to be invested in. So that kind of middle of the sandwich infrastructure layer is where we tend to gravitate.
But it feels like that the Israeli startup ecosystem are a little bit late to the game for the AI. Can you agree with that?
Yeah, that was a little bit the narrative for a bit, but I think everyone was a little bit late to AI. Who was doing large language model technology other than OpenAI and a few others? So it was very and I think 6 to 8 months ago, you looked around and there was, kind of seemed like Israelis got caught flat-footed, but I think everyone was like that. And now we're starting to see a lot of interesting companies. I think founders here are very talented. I think they've figured some stuff out, and I think we're going to see some really interesting companies emerge in the next few years.
I'm sure about that. Okay, we're getting to the end. Let me first of all get some. Would you recommend early growth stage startups before they go in looking for funding for their growth stage?
Well, one of the things that we've learned as a fund, and I didn't get into it, but we were part of a platform, and we didn't have to do kind of our own fundraising and things like that. And we spun out at the end of 2019, and one of the things we learned is really try to understand what the product you're selling is, and the mindset of who you're selling that product to. And so I think that there is a little bit of a nuance to raising an early growth round that maybe didn't exist in the earlier stages. I think the early stage, you're selling a vision, and it doesn't mean that the vision goes away, I think, but the vision needs to be supported by additional signals that are coming from the business. Like if you think about it from an investor's perspective, if your deck and message is exactly the same in Series B as it was in Series A, then why should a Series B investor, give you a higher valuation or pay more for the equity than a Series A investor? What cards have turned over that provide that de-risking for the investor to come in? And it's usually metrics and business proof points that support that vision more so than was the case in, let's say, the Series A. And so I think just understanding that nuance and maybe the types of the type of pitch that worked in the seed and Series A might have to be tweaked for Series B, and having those conversations. It sometimes might help also just have friendly conversations with people who invest at that stage, who you might be in your network before you actually go and pitch and kind of tweak it. But probably the most important thing is to just build a great business. And what we find is we try to find those great businesses, and we're the ones usually inbounding those companies rather than the other way around.
So in other words, if they come to you with sales funnel, you can go and take it and to take this product market fit to market product sales fit, right? That's what are gonna help to increase and double their metrics, right?
Yeah, that finding I guess providing proof points that product market sales fit exists. And that there's predictability, because a lot of the capital is going to go to putting it into sales and marketing, and you want to be able to have confidence that it's going to translate into revenues at the right rate, at the right efficiency that we spoke about earlier. So anything you can do to kind of help show that and give supporting evidence to that would be helpful.
Beautiful. Okay, this is the last but not the least. Can you give us a recommendation of a podcast or a book you're reading and a fun fact about yourself?
All right. Well, I thought you'd maybe give me a heads up with this, so I gotta think on my feet here. A podcast. I think I like 20 VC.
I love it.
I think he does a good job.
Yeah.
Harry Stebbings, he does a very good job of interviewing interesting people. And I think it sounds like for the audience that you're targeting, probably a good idea to get also a lot of information. That's at least in the VC. There's other non-VC podcasts. And a fun fact about myself, I saw my wife on TV as that was how I met her, and I somehow managed to track her down. So that's maybe a fun fact. And now, 3 kids later, we're just a regular, boring family. But it started in a pretty cool way, I guess.
Amazing! Wow, this is a really fun fact. This is the new.
There you go. More details
Yes.
over beer, Daniel. Next time we meet up.
Brilliant. So.
Yeah.
And there you have it, valuable insights and advice from Avery Schwartz. I hope you found this interview informative and helpful in your own journey to startup success. If you enjoyed this episode, share it with your friends, subscribe to it, and keep watching for more episodes of this series and get more valuable tips on how to build, grow, and raise funding for a startup. So big thank you, Avery Schwartz, for your talking here and sharing your knowledge with us. Until next time, keep working hard and remember, it's not always about